There's a rule about money that almost every economics textbook agrees on. When a country raises its interest rates, its currency gets stronger, investors chase the higher yield, and they buy that currency. It's almost a law of physics. So in June of 2026, when the Bank of Japan finally raised rates to a 31-year high, the yen should have soared. Instead, it did the exact opposite. It collapsed to nearly 162 yen to the dollar, a 40-year low. The rule broke. And when a rule breaks in Tokyo, it has a habit of sending the bill to New York. This is a story about the yen carry trade, how the most boring-looking trade in the world quietly became the fuse sitting under the entire global market. Before we begin, let me make you a promise. By the end of this video, I will put real names and real tickers on your screen. Who makes money when this breaks, who gets wiped out, and the 3 stocks the market is already betting on. But for that answer to mean anything, you first have to understand why a Japan story is really your portfolio's story. Our story starts 30 years ago. While most of the world worried that prices were rising too fast, Japan was fighting the opposite problem. Prices that simply would not rise at all. Deflation. When things don't get more expensive, people delay spending. When spending falls, the economy cools, and when the economy cools, prices fall even further. A doom loop. To break it, the Bank of Japan pushed interest rates down to 0, sometimes below it, and left them there for nearly 30 years, the cheapest place on earth to borrow money. Japan became the world's ATM. These 30 years have a name: the lost decades. Prices, wages, stock prices, all of it essentially frozen in place. An entire generation lost its faith that tomorrow would be better than today. So for the Bank of Japan, making prices rise wasn't just a policy, it was breaking a 30-year curse. Now here's where something very human happens. If you could borrow money for almost nothing, would you leave it sitting in Japan earning 0? Of course not. You'd take it to the United States earning 5%, or somewhere paying even more. And that is what turned the yen into the world's funding currency, the cheapest fuel on the planet for anyone, anywhere, looking to invest. And this world's ATM didn't appear by accident. In 2013, Japan made it official policy. Abenomics. Governor Haruhiko Kuroda unleashed unlimited money printing and eventually pinned even long-term rates near 0 with an extraordinary tool called yield curve control. The 30-year era of cheap yen was built on purpose. And anything built on purpose eventually has to be unbuilt on purpose. This trade has a name, the yen carry trade, and it moves in 4 steps. 1. You borrow yen at almost 0%. 2. You convert that yen into dollars. 3. You put it into something that pays more, like a 5% US Treasury bond. 4. You keep the difference, the spread. Borrow at 0.5%, earn 5.3. That gap, nearly 5%, lands in your pocket for producing nothing, just sitting on the difference between 2 countries' interest rates. The catch is that 5% isn't actually that much, so traders add leverage. They borrow on top of what they've already borrowed, multiplying the bet. A 5% spread with 5 times leverage becomes more than 20%. Quiet, steady, almost free money. But remember this one sentence. This trade climbs the stairs on the way up, gains one slow step at a time. On the way down, it takes the elevator. Later, you'll see why that single line is the whole story. So who actually does this? Broadly, 3 groups. First, global hedge funds. The most leveraged hot money. They make the most and they run first. Second, Japan's giant institutions, especially the National Pension Fund, GPIF, which manages $1.7 trillion and parks roughly half of it in foreign assets. And third, maybe the most surprising player of all, ordinary Japanese households. The market has a nickname for them, Mrs. Watanabe. Everyday investors borrowing cheap yen to bet on foreign assets. At one point, Japanese individuals made up nearly half of all retail currency trading on the planet. If it's still abstract, let's put numbers on it. Borrow 1 million yen at 0.5% and put it into a US bond paying 5.3. In a year, the interest difference alone is 48,000 yen. Add 5 times leverage, and that becomes 240,000 yen, a 24% return on the money you actually put in. whether stocks go up or down, just sitting on the gap between two countries' rates. That's why for 30 years, the whole world got addicted to this trade. So how big is this really? Here we have to be honest. The media loves to call it a $4 trillion carry trade. But that isn't a number sitting in one ledger. It's a rough estimate of all the world's overseas positions funded with yen added together. The actual leveraged, speculative positions, the ones that can blow up overnight, are far smaller. So the point isn't the precise number. The point is the direction. Money that flowed out of Tokyo is now quietly woven into assets in New York, in Sao Paulo, in Mumbai. But one question remains. Why couldn't Japan raise rates for so long? The answer is debt. The Japanese government's debt is more than 250% of GDP, the worst in the developed world. Raise interest rates, and the interest bill on that mountain of debt explodes. So Japan was, in effect, a prisoner of its own rates. Without cheap money, it simply couldn't carry the debt. For 30 years, this plumbing worked quietly and well. And to break all of it, only one thing has to change. The cheapest money in the world has to stop being cheap. In other words, Japan has to raise interest rates, and in 2026, for the first time in 3 decades, that is exactly what began to happen. For 30 years, Japan agonized over prices that wouldn't rise. Then, in 2026, something changed. Inflation came back. In May, core inflation hit 1.8%. In any other country, that's an unremarkable number. But in a country that couldn't break above zero for 30 years, this is an event. The fuse that had slept for so long had finally been lit. So the Bank of Japan pulls the real trigger. For the first time in 30 years, it raised rates to 1%, a 31-year high. The beginning of normalization. But inside the bank, the room was split. On one side, the hawks, raise another quarter point every few months. On the other, the cautious camp. Go slow, move too fast, and the whole thing breaks. The tension in that room becomes the seed of everything that follows. The man who made this call is Governor Kazuo Ueda, not a flashy politician, a quiet academic. He was trying to become the first governor to end a 30-year experiment, and to do it without detonating anything. The most careful monetary turn in history was being conducted by his hand. But there was one more decisive reason the Bank of Japan finally moved after 30 years. This time, prices weren't rising just because imported goods got more expensive. Wages went up. Japan has a springtime ritual called shunto, the spring wage negotiations. And this year, for the first time in ages, it produced a meaningful raise. Prices rise, so wages rise. Wages rise, so people spend. And that pushes prices up again. What economists call demand pull inflation. This was the signal of the virtuous cycle Japan had waited 30 years to see. Wait, let me give you a small preview here. When rates rise, who smiles? Japan's giant banks held down for 30 years. And if the weak yen keeps going, Toyota and Sony get fatter, while their rivals, Korea's Hyundai and Kia, get squeezed. But this is only a trailer. The full board, with the names and the tickers, comes later in this video. This is where the story starts to twist. At the very moment the Bank of Japan hits the brakes, the government was flooring the accelerator. It slashed the food consumption tax from 8% to 1%, giving up 4.4 trillion yen in revenue to do it. At the same time, it announced it would pour $2.3 trillion into AI, semiconductors, and space by 2040. One side tightening, the other loosening. Inside a single country, two opposite forces slam into each other. The symbol of where that $2.3 trillion is headed is semiconductors. Through a national project called Rapidus, Japan has declared it will mass produce the world's most advanced 2-nanometer chips by 2027. Once a semiconductor kingdom that lost its throne, Japan is throwing itself back in, with the nation's fate on the line. The problem? Even this enormous bet ultimately needs cheap money, in the exact opposite direction of normalization. And the government doesn't entirely mind a weak yen. The cheaper the yen, the more exporters earn, and the more tourists pour in. So Prime Minister Takaichi asks the Bank of Japan for policy coordination. A diplomatic phrase, but the meaning was clear. Don't raise too fast. A central bank is supposed to be independent, and here the government is, in effect pressuring it to slow down. When the prime minister pressed for a slower pace, the market grew uneasy. Because if a central bank's independence wobbles, faith in the currency wobbles with it. So the government rushed to write the independence of the Bank of Japan directly into its economic policy framework. It was a message to the market: we will not cross the line. That's how delicate this balance had become. And here is the central dilemma of this whole story. Japan has to raise rates because the fuse called inflation is burning. But the price of doing it is almost too much to bear. The bond market shakes, the yen lurches, and the entire global carry trade trembles. So Japan begins a high-wire act: raise rates, but let it show as little as possible. The problem is the market has already caught on. Now we come back to that paradox from the cold open. Japan raised its rates. By the textbook, the yen should have grown stronger. Instead, it went the other way, collapsing to nearly 162 yen to the dollar, a 40-year low. Japan had drawn its weapon, and it hadn't worked. Why? There are 3 reasons. First, the market buys the future, not the present. A hike this size was already priced into the yen. Second, even after the hike, the gap with the United States was still enormous. 5% in America, 1% in Japan. The engine of the carry trade was still turning. And third, the market saw right through it. It understood that Japan, in the end, had no choice but to move slowly. Even raising rates wasn't enough to reverse the direction the yen was already flowing. Here's just how skeptical the market was. In the very middle of Japan raising rates, Goldman Sachs forecast that a year later the yen would be weaker still, all the way out to 165 to the dollar. The central bank was defending its own currency, and the world's top investment bank was betting it would fall further. That gap, that was the size of the corner Japan was backed into. Now a different arm of the government steps in, the Ministry of Finance, and it warns of decisive action. The market read one specific number as the line of defense: 160 yen to the dollar. If the yen slipped past that line and weakened further, it was a signal that the government would step directly into the market. A line drawn in the sand. And here's something you should know. Intervention where the government actually buys the yen is not something it does casually. After 1998, Japan did not buy yen to defend it again until 2022, a weapon it had not reached for in 24 years. That's how much it means. Intervention is the last signal, the one that says this is now truly dangerous. And in 2026, that weapon came out again. But does intervention actually work? 2022 gives the answer. In September and October of that year, Japan poured in more than 9 trillion yen in just 2 months, and still, the yen kept weakening. The market learned a lesson. Intervention buys time, but it can't reverse the tide. So the 2026 intervention, too, wasn't a solution. It was just holding on. And the warning turned into real gunfire. In April and May, to defend the yen, Japan poured in 11.7 trillion yen, about $74 billion, the largest intervention on record. But here comes the decisive detail. To buy yen, you have to sell something, and what Japan sold was dollars. To be exact, the US Treasury bonds it had piled up in dollars. Here we have to grasp the scale. Japan is one of the largest holders of US government debt in the world, more than $1 trillion of it. That vast holding is a lever resting on top of the single most important market on earth, US Treasuries. Move it even a little, and American interest rates shift. The hand reaching out to save the yen is touching the beating heart of global finance. But this weapon has a fatal flaw. Intervention to make the yen weaker can go on forever. You simply print more yen, but intervention to make it stronger, the defense Japan is running right now, means selling the dollars it already holds. The ammunition is finite. And so the market always asks the same question: how long can Japan hold out? And that ammunition, it is US Treasury bonds. But the most astonishing moment of all came without a single shot being fired. One day, a report surfaced that the top finance officials of the United States and Japan had held a video call. Not the substance of the call, just the word that they had met. And that alone was enough to send the dollar-yen dropping from 162 to 161. A single word, a single phone call, moved the market. That is how tightly wound the market had become. And this was never Japan's fight alone. Right next door, South Korea was struggling with a weak one of its own. The two countries signaled they might coordinate in the currency markets. In the face of one enormous wave, a strong dollar, all of Asia was in the same boat. Tokyo's problem was already spilling across borders. Now, this is the single most important moment in the entire video. To defend the yen, in the month of May alone, Japan sold off $66.8 billion worth of US Treasury bonds. But when you dump US Treasuries in size, the interest rates of that country go up. By some estimates, enough to push the US 10-year yield higher by 20 to 50 basis points. In other words, Tokyo's move to protect its own currency reaches all the way into the mortgage rates of New York and the interest bill of the American government. To defend the yen is to sell America's debt, and that is the very first channel through which a Japan story becomes the world story. Now the stage moves to the bond market. Doesn't sound very exciting, does it? And yet, this is exactly where the real time bomb is hiding. Japan's 10-year government bond yield has climbed to 2.88%, just under 3%, its highest since 1996, 30 years. A yield that had been asleep for 3 decades has finally woken up. And when a yield wakes up, it means the pressure that was held down for all those years is bursting back out. So why did this happen? 2 things at the very same time. 1, to pay for all that stimulus, the government printed an enormous wave of new bonds. Its growth strategy alone rested on 371 trillion yen. Supply exploded. 2, the single biggest buyer that had been soaking up those bonds for years, the Bank of Japan, started buying less. That's part of normalization, quantitative tightening, or QT. More sellers, fewer buyers. The result is almost boringly predictable. Yields spike, and the market is now holding its breath over one psychological line: 3%. The warning rang out in the bond auction room too. At an auction where the government tried to sell its bonds, demand visibly weakened and the winning yield jumped. What does that mean? The market was beginning to say, not at this price. After 30 years of buying Japanese bonds without a second thought, investors were finally putting a price on them. But this plan, pushing the bonds onto the public, hides a trap. If households and pension funds all crowd into government bonds at once, they may have to sell something else to find the cash, stocks or overseas investments. You plug one hole and the water leaks out of another. In the worst case, this doesn't defuse the bomb at all. It simply moves the bomb into the hands of the people. Let's stop and catch our breath for a second. We are now almost exactly halfway. The world's ATM, the lit fuse, the line at 160, the reawakened bond yield. Everything up to this point has really been the build-up to a single question. When all of this finally goes off, who makes money and who loses everything? That answer is coming, and it's coming soon. Stay with me just a little longer. So how does Japan plan to handle this bomb? It reaches for a remarkable answer. It hands the bomb to its own people. The government began urging households and pension funds to buy Japanese government bonds. Take the tax-free investment accounts known as NISA. They hold 73 trillion yen. If even 10% of that flows into bonds, that's 7 trillion yen of brand new demand. The National Pension Fund, GPIF, holds 293 trillion yen, and from that alone, it has room to buy up to 17 trillion yen more. The idea is to fill the seat the Bank of Japan is quietly vacating, with the savings of ordinary citizens. But telling the National Pension Fund, GPIF, to buy more government bonds carries a heavy meaning. It ties the public's retirement savings to the government's debt, and if bond yields rise further, those paper losses ultimately land on the citizens nearing retirement. This may not be diffusing the bomb, it may be moving it onto the shoulders of the people least able to carry it. But hiding right here is a side effect, quiet and deeply unsettling. When Japanese bond yields rise, there's suddenly far less reason to shoulder the risk of sending your money abroad, because now you can earn interest at home. So Japanese money that had spread out across the whole world begins, little by little, to come home. There's a word for this: repatriation. And that cheap fuel, the fuel that flowed out to the world for 30 years, is starting to dry up. And what happens when that fuel runs dry, we have already seen once before. Up to now, we've been talking about what if, but this is not hypothetical, because it has already happened once. August 2024. The first domino fell in Tokyo, and within days, it had knocked down New York. From here, I'm going to replay exactly what happened that day. Remember the line, gains climb the stairs, losses take the elevator. Here is how that elevator works. When the yen suddenly strengthens, everyone who borrowed yen to invest is instantly sitting on a loss. And because the trade is leveraged, that loss is multiplied several times over, so the margin call arrives. To repay the debt, they have to buy the yen back. And to buy the yen back, they have to sell US stocks, treasuries, emerging market currencies, anything they can get out the door. That selling drives the yen even higher, which triggers even more margin calls, and a spiral that feeds on itself begins. In 2024, the trigger was pulled over 2 days. On July 31st, the Bank of Japan raised rates, catching the market off guard. The cost of fuel for the carry trade had just gone up. And 2 days later, on August 2nd, US jobs data came in shockingly weak. Hiring fell far short of expectations, and a fear spread that America might be sliding into recession. On one side, the cost of borrowing yen was rising. On the other, US rates were now expected to fall. The two pillars of the carry trade were shaking at the very same moment. That morning, the accounts of ordinary Japanese households caved in. The Mrs. Watanabes, the trade they'd believed was safe for 20 years, came back as a margin call within hours. What they had climbed slowly up the stairs, they lost in a single day's elevator drop. This was never just a hedge fund story. It happened at kitchen tables in Tokyo too. And on August 5th, the dam broke. Japan's Nikkei index crashed 12.4% in a single day, its worst day since the 1987 Black Monday. The fear gauge, the VIX, spiked to 65 intraday. The dollar-yen fell from 162 to 142 in just 3 weeks, the yen surging more than 12%. And this earthquake did not stay in Tokyo. That same day in the United States, the S&P 500 fell 3% and the Nasdaq fell 3.4%. Japan's carry unwind had reached all the way into your account in New York. But doesn't that seem strange? Why would a Japanese carry trade take down American tech stocks? The answer is in the brutal logic of the margin call. When you need cash in a hurry, you sell what you can sell. Not the broken assets, but the best, most liquid ones first. So the bluest of blue chips, Apple, Nvidia, are the first thrown overboard. Assets that normally have nothing to do with one another all collapse in the same direction, at once. It's what traders mean when they say correlation goes to 1, and it gets worse. When volatility spikes, risk parity funds, funds required by their own rules to cut risk, are forced to sell even more. Selling begets selling. Here's the fascinating part. The earthquake was over almost as fast as it began. JP Morgan estimated that within a few days, 3/4 of the carry trade had already been unwound, and by around August 9th, US stocks had recovered most of their losses. A few-day earthquake. But that is exactly what makes it frightening. The structure itself never went away. Once the unwind was finished, the carry trade quietly began to rebuild, the seed of the next earthquake. And the next part was crueler still. When the market snapped back in a V within days, the people who had panicked and sold at the bottom missed the entire rebound. An unwind wounds both sides. Those who don't sell get hit by the crash, those who do get hit by the recovery. When volatility explodes, the very idea of winning disappears. And 2024 was not even the first time. In 1998, when the hedge fund LTCM collapsed, the yen moved 7% in a single day, one of the largest one-day moves in the history of foreign exchange. In the 2008 subprime crisis, it was the same story. Risk appetite breaks, margin calls fly, the yen spikes. Every time, the same script. August of 2024 was simply the latest episode in a story that keeps repeating. There's an old phrase in the bond market, the bond vigilantes. The idea that if a government prints too much debt, bond investors punish it by driving yields higher. In America, it's a familiar story. In Japan, it slept for 30 years, because the Bank of Japan bought everything. But now, that vigilante may finally be stirring in Tokyo. So now we know. This is no longer a question of if, it's a question of when. It has already blown up once. The structure is still in place. And this time, Japan is raising rates in earnest for the first time in 30 years. The fuse is still burning, which leaves only one question. When this breaks, who makes the money and who loses everything? That is the moment I promised you. And it's finally here. At the very start of this video, I made you a promise that I would put real names and real tickers on your screen. This is that moment. But first, let me be clear about one thing. This is not financial advice. I'm not telling you to buy any particular stock. Think of it instead as a map. It shows you where this enormous force is pushing and how. And on screen, I'll use two kinds of labels. Source grounded means the actual news tied this stock to the story. Analysis means it's a connection we're drawing with our own logic. The first group of winners, the stocks that gain from a weak yen. Exporters like Toyota and Sony. The reason is simple. They earn dollars overseas and then translate that money back into yen on their books. The cheaper the yen, the more yen each single dollar becomes. Their profits swell without anyone lifting a finger. And in fact, in our own source data, every time the yen moved in the news, these two names showed up again and again. But the real protagonists are somewhere else. Japan's giant banks, Mitsubishi UFJ, Sumitomo Mitsui, Mizuho. For 30 years, zero rates were a curse on the banks. They could lend money out and earn almost no interest on it. But when rates return to normal, the margin between what they pay on deposits and earn on loans comes back to life. For the banks, it's the first spring in 30 years. And here's the striking part. When we scraped every tagged ticker across 45 news articles, the top 4 by frequency were all of these banks, plus the brokerage Nomura. Which means the names the market is watching most closely in this whole story are exactly these. There's an intriguing hint here. A few years ago, Warren Buffett made a big bet on Japan's Sogo Shosha, giant trading houses like Mitsubishi Corporation and Itochu. He borrowed cheaply in yen to buy high-dividend yen assets. It was a move worthy of a carry trade master, straight out of the textbook. The greatest investor in the world was already sitting at this table. There's one more group of winners, created by normalization and stimulus together. Semiconductors. The exact place the government's $2.3 trillion is headed. Chip equipment makers, Tokyo Electron and Advantest, and SoftBank, which holds ARM in its hands. A weak yen sharpens their export competitiveness, and the nation's investment backs them from behind. It's one of the few seats where the currency and the policy both push in the same direction. Now the other side, the losers. A weak yen is poison for anyone who imports. The classic example is Apple inside Japan. We'll come back to this later, but Apple eventually had to raise the price of the iPhone in Japan. Another unexpected loser, the life insurers and some banks that were holding piles of long-dated government bonds. When rates rise, the bonds you already own fall in value. They take a paper loss without moving a muscle. The very same rate hike is spring for one and winter for another. And here's an interesting angle our source data pointed to. Korea's Hyundai and Kia. Why would Korean cars show up in a Japan story? When the yen gets cheaper, Toyota can price more aggressively in overseas markets. Hyundai and Kia, going head-to-head in those same markets, are put at a disadvantage on price. A weak yen is a tailwind for Japan's exporters, but a headwind for their rivals. So every time yen news breaks, the market watches these Korean stocks right alongside it. And the most ironic paradox of all, when a crisis hits, the yen actually gets stronger, because the world treats it as a safe haven. When everything is collapsing, people flee into yen, and that strengthening yen unwinds the carry trade all over again. In other words, the yen is a fire truck that rushes in to put out the fire, and feeds it instead. The flight to safety amplifies the very crisis. Finally, the widest net of all. What if an unwind like August of 2024 comes again? Then it's no longer just a Japanese stock problem. An unwind means you sell what you can sell. And the most liquid US large cap tech and the highest risk assets get thrown overboard first. So, paradoxically, the biggest victim of an accident that started in Tokyo may be sitting in New York. And here's another twist. When the yen spikes, even the Japanese exporters we just called winners take losses this time. In the moment of crisis, the line between winner and loser flips. And there's one more fascinating winner, the Chicago Mercantile Exchange, CME. Every time the yen lurches, every time an intervention hits, trading in yen futures and options explodes. CME brokers those trades and earns a fee on every one. Whichever way the market goes, it's a seat that makes money from the volatility itself. And sure enough, in our source data too, this name appeared with every yen intervention story. So, the 3 stocks the market is already betting on that I promised at the very start. The data gave us the answer. The three names that appeared most often across 45 news articles, and by an overwhelming margin, were Japan's three big megabanks: Sumitomo Mitsui, Mitsubishi UFJ, and Mizuho. The seat that stands to smile the widest if normalization is for real, and the seat that gets put to the test first if that normalization shakes the market. The market has, in effect, already staked the ending of this story on these three stocks. And let me say it once more, this is not financial advice. It's a map. We've drawn the full map of winners and losers. But this enormous story, where is it finally felt? Not on a hedge fund's terminal, not on a bank's balance sheet. It begins at the fingertips of one person, picking up an iPhone in some shop in Tokyo. In the summer of 2026, Deutsche Bank published a curious finding. The cheapest city in the world to buy an iPhone is Tokyo. And the reason is the very thing we've been tracing this whole time: the weak yen. Since 2012, the yen has lost more than half of its value, and Japan has quietly become a cheap country. For tourists, it's paradise. For the people who live there, it's a quiet kind of poverty. The same goods cost the same everywhere else in the world. It's only in your own currency that they keep getting more expensive. But that cheapest in the world title didn't last long. Barely a month later, Apple raised the price of the iPhone in Japan by more than 10%, driven by the cost pressure of the weak yen and by soaring memory prices. The world's cheapest iPhone city became the first to reprint its price tags. It's the moment a vast macroeconomic force finally comes to rest on a single paper price tag, sitting on a single shelf. The last piece isn't money, it's people. In the first half of 2026, the number of tourists visiting Japan fell for the first time in 5 years. Chinese visitors, in particular, plunged by more than 60%, and the cause wasn't economic, it was political. Prime Minister Takaichi's remark about Taiwan spilled over into a diplomatic clash, and the fallout carried straight through to flights and inbound tourism, currency, interest rates, government bonds, and now geopolitics. Every thread is tangled together inside a single country. And there's one more quiet bill coming due. Some young Japanese have begun leaving, for Australia, for anywhere, chasing higher wages. Because in a country whose currency has weakened, even human labor becomes cheap on the world market. The most human cost of a 30-year experiment may not be a number at all. It may be the sight of people walking away. So, what should you be watching from here? It comes down to just 3 numbers. First, the next Bank of Japan meeting. How much further do they hike? Second, 160 yen to the dollar. If that line breaks, intervention follows. And third, the 10-year government bond at 3%. Cross that threshold, and the bond market starts to shake. The moment any one of these 3 gives way, the first domino we've been talking about begins to move. And so Japan stands, right now, on a tightrope. Raise rates too fast, and the bond market and the carry trade come down. Raise them too slowly, and the yen collapses, and rising prices crush the people at home. To end a 30-year experiment in ultra-low interest rates without detonating any of it, that is threading a needle. And the moment that thread slips, even slightly, the bill does not stay in Tokyo. It flies to New York, to Seoul, and maybe to your account. Which is why, even at this very moment, every trading desk in the world is watching one single place: Tokyo. Before the next earthquake comes, I hope you'll keep this map close. And remember, this is a map, not a recommendation. This is not financial advice. So, I'll see you in the next one.